Look, something fundamental just shifted in the global financial system, and most people are going to miss it completely until it's too late. We're watching the end of a 40-year cycle play out in real time, and the signs are everywhere if you know where to look. For decades, paper assets have been the golden ticket. Stocks, bonds, real estate financed with cheap debt. The formula was simple. Borrow cheap money, buy assets, watch them inflate, repeat. Central banks made sure of it. Every crisis got met with the same response. Lower rates, print more money, keep the party going. But that game is ending, and it's ending fast. Let me show you what I mean. Right now, central banks around the world are buying gold at a pace we haven't seen since the early 70s. Not just buying it, hoarding it. In the past 2 years alone, central banks have purchased over 2,000 tons of gold. That's not normal. That's not even close to normal. These aren't amateur investors making emotional decisions. These are the institutions that control the money supply, that set interest rates, that supposedly have everything under control. And they're quietly, systematically converting their paper reserves into physical metal. Why would they do that? Because they know something the average investor doesn't. They understand that the easy money phase, the era where you could just ride the wave of endless liquidity, is over. The debt levels are too high. The inflation pressures are too persistent. The geopolitical fractures are too deep. Think about what's happened over the past few years. We saw inflation spike to levels not seen in 4 decades. Central banks responded by raising rates faster than any time in modern history. But here's the thing. They can't keep rates high forever. The debt burden is too massive. Governments are paying more in interest than they spend on defense. Companies that thrived on cheap debt are struggling. The system is groaning under the weight. So what happens next? Either they keep rates high and watch the debt spiral collapse the system, or they cut rates and reignite inflation. It's a trap, a monetary policy trap with no clean exit. And that's exactly why hard assets are becoming the only real safe haven. Let's talk about gold for a minute. Gold just hit all-time highs, and it did something remarkable. It rallied while the dollar was strong and while real interest rates were positive. That's not supposed to happen according to traditional models. Gold is supposed to struggle when rates are high and the dollar is strong. But it didn't. It surged anyway. Why? Because the smart money understands that nominal rates don't matter anymore. What matters is trust. What matters is the long-term viability of fiat currency systems that have been stretched to their absolute limits. Look at what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa, they're actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems. And they're backing it all with gold. China hasn't officially reported its gold reserves in months, but every indicator suggests they're accumulating at an unprecedented rate. Russia has been converting its reserves to gold for years. Even countries that have traditionally been dollar allies are diversifying. This isn't conspiracy theory stuff, this is official policy. These nations watched what happened when the West froze Russia's dollar reserves. They saw how quickly financial assets can become weapons. And they decided they need something that can't be frozen, can't be sanctioned, can't be printed into oblivion. They need hard assets. Now let's talk about silver, because silver is setting up for something potentially explosive. Silver has always been gold's volatile little brother. It moves faster, swings harder, and when it runs, it really runs. Right now, silver is facing a supply crunch unlike anything we've seen in decades. Industrial demand is surging because of the green energy transition. Solar panels need silver. Electric vehicles need silver. The entire renewable energy infrastructure being built globally is silver intensive. At the same time, silver mining production has been flat to declining. The easy deposits have been mined out. New projects take years to develop and billions in capital. And with inflation driving up mining costs, many marginal projects aren't economically viable. So you have surging industrial demand meeting constrained supply, and on top of that, you have investment demand starting to wake up. Silver ETFs are seeing inflows again. Retail buyers are stacking physical metal. The setup is remarkable. Here's something most people don't realize about silver. There's actually less investment-grade silver available above ground than gold. Most silver gets consumed in industrial applications. It's used up, dispersed, gone. Gold gets hoarded. silver gets used. That creates a fundamentally different dynamic. When investment demand for silver really kicks in, there's not much available to meet it. The last time this happened, in the early 2000s, silver went from $4 to nearly $50 in a decade. It was a 10-bagger that most investors completely missed, and the setup now is arguably better than it was then. Let me paint you a picture of what's really happening in the physical metals market right now. There's a growing disconnect between paper prices and physical availability. You can see it in the premiums. You can see it in delivery delays. You can see it in the spread between futures prices and actual metal you can hold in your hand. The COMEX, the major futures exchange where gold and silver trade, has been showing some interesting stress signals. The amount of physical metal available for delivery relative to the open interest, the paper claims on that metal, has been shrinking. There are more and more paper claims on each ounce of physical metal. What happens when everyone holding paper gold or paper silver decides they want the real thing? What happens when the trust in paper claims breaks down? We got a preview of this during the pandemic. Premiums on physical gold and silver exploded. You couldn't find metal at anywhere near spot price. The paper market said one thing, but try actually buying physical metal and you paid 20, 30, sometimes 40% over spot. That disconnect is starting to appear again, and it's appearing while prices are already at elevated levels. That tells you something about the underlying physical market dynamics. Now, I want to take a quick aside here, because this is relevant for a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, that kind of thing, you might want to look into how gold IRAs work. I put together a free guide that covers the basics, how to get physical gold into your retirement account without triggering tax penalties, what the rules are, that sort of thing. It's in the description if that's relevant to your situation. Worth understanding your options. All right, back to where this is all heading. The thing about hard assets is they're not just about price appreciation. They're about preservation. They're about having something real when paper promises start to break down. Think about what money actually is. It's a claim on future goods and services. It's a store of value. It's supposed to hold its purchasing power over time. But fiat currencies only do that as long as people trust the institutions managing them. And right now, that trust is eroding. You can see it in inflation expectations. You can see it in the velocity of money. You can see it in the fact that people are increasingly looking for alternatives, whether that's Bitcoin, gold, real estate, anything that's not just paper currency sitting in a bank account losing purchasing power. The Federal Reserve and other central banks have a massive problem. They've created so much money over the past 15 years that there's no easy way to unwind it. The balance sheets are enormous, the debt levels are staggering, and the political pressure to keep spending is relentless. Every crisis gets met with the same response: more money printing, more stimulus, more debt, and each time it takes more and more monetary expansion to get less and less economic growth. That's the definition of diminishing returns. That's the end game of a fiat currency system that's been pushed to its limits. Now, I'm not saying the dollar is going to zero tomorrow. I'm not saying we're going back to the gold standard next week. But I am saying that the era of easy money, where you could just buy paper assets and ride the liquidity wave, that era is ending. The next phase is going to be different. It's going to reward people who own real things, hard assets, tangible value, things that can't be printed, can't be diluted, can't be inflated away. Gold and silver are the most obvious plays, but it's broader than that. It's productive farmland, it's energy resources, it's commodities, it's anything with intrinsic value that exists in the physical world. Let me give you a historical parallel. In the 1970s, we went through a similar transition. The Bretton Woods system collapsed. The dollar was delinked from gold. Inflation surged. And for a decade, paper assets went nowhere while hard assets exploded. Gold went from $35 an ounce to over $800. Silver went from $1.50 to $50. Oil went from $3 a barrel to $40. Farmland prices tripled. Commodities across the board had massive runs. Meanwhile, the stock market went sideways for a decade. Bonds got destroyed. Cash lost half its purchasing power. The traditional 60-40 portfolio was a disaster. The people who preserved and grew wealth during that period were the ones who understood the shift. They moved out of paper and into hard assets. They positioned themselves for an inflationary currency debasement environment. And we're setting up for something similar now, except the scale is bigger. The debt levels are higher. The monetary expansion has been more extreme. The geopolitical tensions are deeper. The playbook from the 70s is relevant, but the magnitude of what's coming could be much larger. Here's what most people miss about gold and silver. They're not just investments. They're insurance. They're the ultimate form of financial insurance against monetary chaos, against currency debasement, against the breakdown of trust in paper systems. When you own physical gold and silver, you own something that has been recognized as valuable for thousands of years. You own something that doesn't depend on any government's promise, any central bank's policy, any corporation's balance sheet. You own something real. And in a world where everything else is increasingly abstract, digital dollars, electronic bonds, paper claims on paper claims, that realness matters more than ever. Think about the average person's financial situation right now. They've got money in a bank account earning basically nothing while inflation runs at 4, 5, 6%. They've got a 401k invested in stocks that are trading at historically high valuations. They've got a house that's appreciated but is financed with a mortgage that's underwater if rates stay high. Everything is leveraged. Everything is dependent on the system continuing to function smoothly. Everything is vulnerable to a loss of confidence. What happens if we get another financial crisis? What happens if inflation comes roaring back? What happens if the geopolitical situation deteriorates further? The people who are going to weather that storm are the ones who have positioned themselves in hard assets, the ones who have something real that holds value regardless of what happens to paper markets. Now, let's talk about the supply side of this equation because it's critical. Gold and silver don't just appear out of thin air. They have to be mined, refined, transported, and that process is getting harder and more expensive. The easy gold has been found. The high-grade deposits have been mined out. New discoveries are rare and getting rarer. The average grade of gold ore being mined today is a fraction of what it was 50 years ago. That means miners have to move more rock, use more energy, spend more capital to produce each ounce. And with inflation driving up costs across the board, labor, equipment, energy, everything, the cost of production has been rising steadily. There's a floor under gold prices now based purely on production economics. Below a certain price, mines shut down, supply contracts, and that floor keeps rising as costs increase. Silver has the same dynamic, but it's even more pronounced because most silver is produced as a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. The rest comes from copper, lead, zinc operations where silver is a secondary product. That means silver supply is relatively inelastic. It doesn't respond quickly to price signals. Even if silver prices double, you're not going to see a flood of new supply hit the market because most of it comes from mines that are primarily producing other metals. This supply inelasticity combined with surging industrial demand creates a powder keg. When investment demand kicks in on top of that, prices can move violently. We saw this in 2011 when silver briefly touched $50. We saw it in the late 70s when it spiked even higher. And we're setting up for potentially another one of those moves. The difference this time is the industrial demand component is much stronger. The green energy transition is real. Solar installations are growing exponentially. Electric vehicle adoption is accelerating. All of that requires silver, and lots of it. Some estimates suggest that the solar industry alone could consume more silver in the next decade than currently exists in above-ground inventories. That's not speculation. That's based on announced projects and installation targets. Where's that silver going to come from? Either prices have to rise enough to incentivize more production and recycling, or the projects don't get built. It's that simple. And here's the thing. Governments around the world have committed to these green energy transitions. They've passed legislation. They've allocated funding. They've set targets. They can't easily back away from it now. That means the demand for silver is essentially locked in. It's going to happen regardless of price. The only question is how high prices have to go to bring forth enough supply. Let's zoom out and look at the bigger picture for a moment. We're living through a period of massive structural change in the global economy. The post-World War II order is breaking down. The dollar-centric system is being challenged. The era of globalization is giving way to regionalization and nationalism. In times of great transition like this, Hard assets have always been the safe haven. They've always been where wealth flows when the old order breaks down and the new order hasn't yet been established. Gold and silver are the ultimate transition assets. They bridge the gap between the old system and whatever comes next. They hold value regardless of which currency regime prevails, which political system dominates, which economic model succeeds. That's why central banks are accumulating them. That's why smart money is positioning in them. That's why you're seeing this quiet, persistent bid under precious metals, even when traditional models say they should be weak. The market is telling you something. The question is whether you're listening. Now, I want to address something that comes up a lot. The idea that gold and silver don't produce cash flow, don't pay dividends, don't generate yield. That's true. They're not income-producing assets, but that misses the point entirely. Gold and silver aren't meant to be income investments. They're meant to be wealth preservation vehicles. They're meant to maintain purchasing power over long periods of time. If you look at gold over the past 50 years, it's roughly kept pace with the expansion of the money supply. It's maintained its purchasing power. An ounce of gold today buys roughly the same amount of goods and services as an ounce of gold did 50 years ago. Can you say the same about the dollar? Can you say the same about any fiat currency? The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. Every fiat currency in history has eventually gone to zero. The average lifespan of a fiat currency is less than 30 years. Gold has been money for 5,000 years. Silver has been money for just as long. They've outlasted every empire, every government, every currency system that's ever existed. That's not a coincidence. That's because they have intrinsic value. They're scarce. They're durable. They're divisible. They're recognizable. They have all the properties of good money. And in a world where trust in paper money is eroding, those properties matter more than ever. Here's what I think is going to happen over the next few years. We're going to see continued volatility in paper markets. Stocks are going to swing wildly as the Fed tries to navigate between inflation and recession. Bonds are going to struggle as debt levels remain elevated and inflation stays persistent. Real estate is going to be mixed. Some markets will do well, others will struggle, but overall it's going to be choppy as affordability remains a major issue. Meanwhile, hard assets are going to grind higher. Gold is going to push toward $3,000 and beyond. Silver is going to break through its old highs and potentially make a run at triple digits. Commodities broadly are going to outperform as supply constraints meet persistent demand. The wealth transfer from paper to hard assets is going to accelerate. The people who position themselves ahead of this shift are going to preserve and grow their wealth. The people who stay fully invested in paper are going to watch their purchasing power erode. It's not going to be a straight line. There will be pullbacks. There will be periods where it feels like nothing is happening. But the underlying trend is clear. The easy money phase is over. The hard asset phase is beginning. And the time to position yourself is now, before the crowd figures it out, before premiums explode, before physical metal becomes hard to find, before prices gap higher and don't look back. This isn't about getting rich quick. This isn't about speculation. This is about understanding the fundamental shift that's happening in the global financial system and positioning yourself accordingly. The institutions get it, the central banks get it, the smart money gets it. The question is, do you get it? Because the window to position yourself at reasonable prices is closing. Every day that passes, more people wake up to what's happening. More capital flows into hard assets. More physical metal gets locked away in strong hands. The opportunity is now. The setup is clear. The risk-reward is compelling. Hard assets aren't just an investment thesis anymore. They're a necessity. They're the only rational response to a monetary system that's been pushed beyond its limits. The easy money phase is over. Welcome to the hard asset era.